Hi, my name is Ravi Raghavan, and I'm the tax partner at Majmudar and Partners. We are a legal firm established in 1943. And I co-head the tax practice along with Mr. Akhil Hirani, who is the managing partner. And I have a few pointers on the budget proposals that were made yesterday by the Honorable Finance Minister. And I have a few takeaways for the listeners here in respect of the amendments that have been made in the budget proposals. When I looked at the finance bill, there are about 122 amendments, and a few of them, are in respect of ease of doing business, tweaking the language in certain provisions in respect of penalty proceedings. And there are a lot of others in respect of personal taxation, IFSC, transfer pricing, special economic zone units, etc., etc. So a few takeaways from the budget from my side will be, the first one will be, on personal income tax, where I see a lot of buzz in the press reports as well as the papers today, wherein a new tax regime has been brought into place with about 7 slabs and tweaking the tax rates. So what happens is the salaried taxpayer has the option of either using the new default tax regime or can opt for the earlier regime. If you opt for the new regime, which has 7 slabs and reduced tax rates, then you cannot claim any deductions under the income tax law. So rather than, being very happy about the proposed tax slab rates, I would encourage that you do a comparative analysis of the earlier regime taxation, keeping in mind the allowable deductions, and then you go and do a calculation on the basis of what the new regime says. In my view, you could find that there is a slight difference in the, in the takeaway income that you have extra. As per the Honorable Finance Minister, a person who was paying 60,000 will now be paying about 45,000 rupees only, which means that effectively you take about 1,250 rupees extra per month, which is okay and fine, but nothing to be really nothing to cheer about that, but please do the calculation of both the regimes. The second takeaway I have noted down in my diary is, issuing shares at a premium by Indian companies to resident investors was within the angel tax provision. So what it typically means is that if a company issues shares at a premium to a resident investor and the value of such shares is below the fair market value, then the difference between the share price and the fair market value will be considered as income from other sources in the hands of the Indian entity, which meant that this provision does not apply to non-resident investors, and therefore what Indian companies used to do was to issue shares at a premium to non-residents, and this provision does not apply. So that used to be a planning mechanism available. So the Finance Bill 2023 has plucked this particular loophole, and therefore, planning for a premium from non-residents will no more be an option. Otherwise, there will be a tax liability of about 30% on the Indian entity. The third point that I had was in respect of InvITs and REITs, where you have non-residents who are, or sponsors who are, putting in capital into the trust as a loan. And what the income tax law is wanting to do right now is to tax repayment of a debt. Now, I can understand if it's a dividend income, interest income, or something in the nature of interest can be subject to withholding tax at the applicable tax law rates or under the Indian tax treaty rates. But a repayment of a debt, in my view, doesn't come into the ambit of income per se. At least the way I read it currently, I'm not clear on why the finance bill wants to, tax a repayment of a loan as an income in the hands of the non-resident investors at the rate of 40%. So this will be definitely a dampener in my view, and possibly the return of investments and how you arrange your structure will need to be re-examined. The other update is in respect of tax collection at source, where a new provision has been added that when the authorized dealer remits an amount in excess of 7 lakhs to a foreign country, other than on education or on medical requirements, he will deduct tax at the rate of 20%. So in my view, the 20% rate appears to be a little harsh, because ultimately it's out of the remittance that I make is out of my tax paid income. So the only safeguard that I have is to check with my, you should check with your advisors and chartered accountants whether the 20% tax credit will be available to you while you file your tax return on them, and whether you can easily get it. If you don't, then you need to, think about other opportunities. The other point is in respect of special economic zones where, units are established to export manufactured goods or services. In such scenarios, the SEZ unit raises an invoice and the money comes into its account as and when the payer pays it. The finance bill wants the SEZ unit to collect the monies within 6 months. And if that is not done, then the tax holiday that is given to you under Section 10AA of the income tax law will not be available to you, and this becomes a big problem. For example, it becomes very difficult as an Indian company to force a non-resident to pay you this money within a stipulated time, where they have different monthly or half yearly or maybe once in 8 months during their payment cycles. So the SEZ unit will have to re-engage with such non-residents to tell them that if you don't pay me within 6 months, then I will lose my tax holiday, because going to the authorized dealer to getting an extension every time you raise an invoice, which is probably going to be on a monthly basis, is going to be very difficult. So while this is an enabling provision for SEZ units, to get monies quickly, from a commercial perspective, it is often difficult, which is what I have seen. The last takeaway is in respect of allowing relocation of units who are outside the IFSC Gujarat to relocate to Gujarat, and the time period has been extended till March 31, 2025. Now, the Indian government is trying to make the IFSC a financial services hub. You have a lot of benefits that have already been granted to such IFSCs, but probably many people are still not relocating to such a place, and probably that's the reason why 2 more years have been given. Now, the one point that I had was that to make somebody relocate to that location, he has to go lock, stock, and barrel, and he has to work from that location. So unless you work from that location, you will not be eligible for the benefits. So the point is, when a person or entities who have, contacts in various parts of India and abroad have to relocate to, let's say, Gujarat on a permanent basis to get a tax deduction, then it becomes a big problem, because I will need to evaluate how much of money am I going to spend on relocation vis-a-vis, my business requirements, vis-a-vis the tax savings that I'm doing. So therefore, I don't know if an IFSC can be created in each state in India, just like we have the special economic zones all over India. It may be, I have a thought, I don't know how practically that is possible. but that could be one way to look at it. So in a nutshell, I think the budget proposals from the tax front are, they are quite comprehensive. There is no good news. I mean, no bad news is good news, and we don't have inheritance tax. We don't have wealth tax. We don't have gift tax. No taxes in the company law, in the corporate tax rates. No, nothing has been changed. Surcharge has also been reduced for, high net worth individuals earning about 5 crores from 37% to 25%, which is, which was not expected, but a welcome move. Thank you.